Okay, welcome everyone. Am I audible, guys? Welcome everyone. Am I audible, guys? Okay, wonderful. Voice not clear. Why don't you log out and log in, Guru? Because the feedback I'm getting from other people are fairly okay. So, okay, nice guys. So, let us get started with. I hope the TradePoint screen is visible on your the TradePoint software rather is visible on your screens now. Let us get started with a quick look at the daily Nifty. I'm not planning to take too many stock specific questions today because I just wanted to focus on or probably take a objective look at the Nifty and then probably look at some breadth indicators which is available in TradePoint and then come to a logical conclusion about what is happening in the Nifty. So this is your daily chart of Nifty. Let me just make the box size to 0.1%. So if you notice here, from a broader perspective, we were making this wonderful sequence of higher tops and bottoms, and the big question which still remains unanswered is whether this is your higher low or this is your lower high, right? So to word it differently, I'm just wondering if we have started making a bigger sequence of lower tops and lower bottoms. That is the doubt I have in mind. So if that is the case, then what will happen is this will be your lower high, sorry, lower low. This will be your next lower swing high, and maybe we'll just drift lower. But if you're on the bullish camp, probably this swing low is still not broken. So on a broader scale, the series of higher tops and bottoms is still intact. So this low is at 10,000. So we have not broken that low on a closing basis until now. So that on a broader scale, the sequence of higher tops and bottoms is still intact. So if you are someone who is bullish, then that is something that you'll be happy to notice. But for the bearish side people, there are a couple of observations that I wanted to share with you guys. So we have this concept called an anchor column in point and figure charts, which is nothing but a longish kind of a column of X or O, which is longer than the the um, the columns in the near vicinity. So, for example, in this leg down, this is the column of O that really stands out, isn't it? This is the lengthiest column wherein you have the most number of boxes of O in this entire swing down, and the next one, the smaller one after that, is this one. So typically, whenever you see those abnormal sized columns, we typically call them anchor column, and the anchor column has this special property of acting as a support or a resistance. So if you notice, this is your anchor column invalidation level, and Nifty just went there and has turned around. And um, if you're someone who is well versed with point and figure patterns, this pattern is called as a 100% bearish pole, which basically means that this column has totally engulfed the previous bullish column, right? So this swing down has totally engulfed the previous column of O. So, and of course, price is below the moving average. A sell signal has been triggered. So the setup is basically bearish if you look at it. And if I use the 45-degree trend lines, we are still trading below the 45-degree trend line drawn from the highest high. So the only good thing is the trend line drawn from the recent lows, they are still intact. So if this trend line were to break, which will happen on a close below say 570, a daily close below 570 will result in a breach of this trend line, so which will have bearish implications. So let us take a quick look at market breadth. How many of you guys use market breadth in your analysis, and what kind of market breadth study that you use? Can you quickly share your market breadth tools that you generally use? I'm just curious. Or how many of you do not use market breadth at all in your analysis? See, if you're say just a Nifty or a Bank Nifty trader, maybe you can get away with not bothering to look at market breadth. Even there, I think looking at the market breadth always gives you a bit of a clarity in terms of at least position sizing. But if you're someone who deals in cash actively, especially if you have a portfolio and if you actively churn the portfolio, as in, I'm not talking about churning on a daily or a weekly basis, but at least if you take a look at the portfolio on a monthly basis and look for remedial action if need be, then I think being aware of market breadth is always helpful. Yeah, most commonly used market breadth indicator is advanced decline, right? Or a new 52-week high low. So in trade point, if you click on breadth, we have three different breadth indicators, out of which two of them are based on point and figure charts. So we have point and figure X percent and point and figure DT percent. So I will just briefly talk about what PFX percent means. So PFX percent is nothing but so okay. Let me just click on that, and let us run this for the Nifty 50 index. So PFX percent basically calculates how many stocks from the Nifty 50 basket are in a column of X. So if you know the basics of point and figure chart, if you open any point and figure chart, the last column in the chart is either going to be a column of X or it is going to be a column of O. So these are the only two possibilities, right? So this PFX percent indicator, what it does is it counts the number of stocks out of the 50 stocks in the Nifty. It counts the number of stocks which are in a column of X and divides it by 50 and multiplies it by 100. So basically, we are trying to find the percentage of stocks which are in a column of X. So if the price is in a column of X, it basically means that prices are rising. So it doesn't tell you whether we are in an uptrend or whether we are in a correction in a downtrend. Those things are immaterial. What we are looking at is are the prices rising in the short term. That's it. So I'm using a 1% box size, and this is the chart that you see on your screen. A green line that is oscillating between 0 to 100, and any reading above 75 is considered overbought, and any reading below 25 is considered oversold. And this is the market breadth indicator. So if you notice, recently we had gone above that 75 mark, and since then the market breadth is deteriorating, which is not surprising because Nifty has been falling for 7 or 8 days in succession. So obviously your market breadth is going to deteriorate, right? So one thing I want to talk about or emphasize about market breadth is that the extreme readings does not necessarily mean that you should take a contra position. So it is just sort of a cautionary signal for you. It basically tells you that we have sort of exhausted the fuel that is available in the tank. So you better be careful about accelerating, right? So if the breadth indicator is at a overbought condition, it doesn't mean that market is going to top out and get into trend reversal. It is just a cautionary signal. It is telling you that maybe there is not enough room for the price to continue in the same direction for a longer period of time. So if you are holding existing long positions, then you can tighten your stop loss, but avoid taking big ticket long positions when the breadth is overbought. Similarly, when the breadth is oversold, the same deal. it is just cautioning you that don't get overbought on your short positions, because the ammunition has been basically exhausted. So the scope for any further sharp downside is that much limited. Okay. So in fact, what you can do is you can run this DT percent index on an individual. I am showing this for the Nifty 50 index. You can do the same thing for the entire. If you have a screen here, if you look at it, it shows the PFX percent scanner for all the sectoral index that is available at NSE. Can you see it on your screen now? So there is a facility in TradePoint wherein you can run the screener for all the index that's available at NSE, and you can you can quickly get an idea about um, or you can quickly count the number of candidates which are below 15, sorry, below 25, and also count the number of candidates above 25 to get an idea about how overbought or oversold um, the other sectors in the market are, right? So you can just export this to Excel and do the calculation there. So you can easily filter out the candidates, or the number of candidates wherein the breadth indicator is below 25. If the market, if the Nifty has been falling, you can quickly calculate the number of indices which are at a oversold scenario. If you have say more than 70-80% of the total indices at a oversold condition, then it is a classic sign that you should be really careful about expecting continuation of the downtrend. So in fact, my colleague Raju Ranjan had tweeted before the market opened today, saying that things are getting oversold from a sectoral perspective. So be careful about taking aggressive positional shorts in the Nifty. So that was just based on this simple logic. And of course, we have a couple of other interesting tools here. One of them, of course, is this P and F matrix. If you click on matrix, you have the P and F matrix and RS matrix. So what P and F matrix basically does for you is it gives you again a bird's eye view of what the sectoral indices are doing. So if you notice, after the performance score, we have four different box sizes with the ranking scores, right? Can you see that? 0.25, 1, 2, and 3, and finally you have the cumulative ranking score. So what the ranking score tells you is, it basically tells you whether this particular index is in a column of X or O, and how many boxes are there in the column of X or O. So for example, Nifty Auto, in 1% box size, the score is 7. So if I just double click on Nifty Auto, if you notice, in 1% box size, there are 7 boxes of O. So as most of you will be aware, if price is in a column of O, it basically means that the prices are coming down, right? So if I sort it on in 0.25%, if I sort it on the descending order, so if you notice, there are so many candidates, almost 12 to 13 candidates out of the 20 candidates, which are in a column of O, which basically means that more than 60% of the sectoral index are have been falling down in the last few days or whatever. So it basically tells you that most of the sectoral index are in a falling environment. And if you look at the individual PFX percent for these sectors, and if they are at oversold territory, then it gives you a very meaningful intelligence that it is probably not worthwhile to go aggressively short on the Nifty in the current scenario. You can probably just wait for a pullback, and then if there is a fresh sell signal, you can think about taking a short position thereafter, right? And let me also give you a glimpse of Renko chart. So this is your um, what is it? Nifty futures 1 minute. I'm using a 10 box Renko chart. Okay, so Renko chart and point and figure chart, they are sort of similar. Only difference being in a Renko chart, the bricks are aligned in a diagonal fashion, whereas in a point and figure chart, your column of X and O, they are organized vertically. So the advantage with Renko chart is the identification of swing levels, swing high, swing low. It becomes very easy, and it's very objective, right? So I'm just using two moving averages here. One is a 20 period EMA, and the other one is a 40 period EMA. The red one is 40 and the green one is 20. So my simple definition of whether we are in an uptrend or downtrend is price should be above the two moving averages, and the short term green moving average should be above the long term red moving average. That's it. So as long as this configuration is there, whenever price dips closer to the moving average and triggers a buy signal, I'll be interested in taking a long position. That's it. This is a simple strategy that you can think of, right? So what shall I say? In a strong trending market, as you guys must be aware, price has this tendency to run away from the moving average. Then it gets into some kind of a mean reversion or a correction, wherein it will come close to the moving average or slightly dip below it, and then the trend will resume. So typically, trending markets have this basic characteristic. If you don't have a trend, what you will see is price will be straddling across the moving average, and you will see a lot of back and forth action happening. But in a trending phase, if you look at this phase here, you have this perfect configuration, right? We are in a downtrend, and the shorter term moving average is below the long term moving average, and price is below these two moving averages. So there will be a leg down, then a pullback, another leg down, then a pullback. So you can view this particular smooth kind of an action in a Renko chart. And at the end of the day, Renko chart is also it also belongs to the same category of noiseless charts, wherein in this scenario we are using a brick size of 10, which basically means that we need at least a 10-point move for the brick to move up. And of course, if it is moving up, we need a 20-point reversal for it to switch back to a column of or a red brick or a bearish brick, right? So again, as I told you, the identification of swings becomes much easier. And my simple definition of a swing high or swing low is if you if you if you have a low and then a new high is made, then the previous low becomes a swing low, right? So you had a high here and a previous low was broken, so this becomes a swing high. Okay, so you have a low which was broken, so this becomes your swing high, right? So by that simple definition, if you notice, none of the swing highs has been broken until now, right? So we are steadily making this sequence of lower tops and lower bottoms in Nifty until now. So the sequence started on 7th of February, and it has been going on steadily for almost 2 weeks now. So in Renko chart, it looks much more what shall I say, easily identifiable. But if you use maybe a hourly candlestick chart also, the same kind of configuration and the rules that I talked about will hold good. So once you have a clear cut trend, so whenever price reaches or gets closer to the moving average and then triggers a sell signal, those are your best opportunities and low risk opportunities, right? So this sequence will continue, and then eventually what will happen is the trend reversal happens, wherein your price will cross over above the moving average, and then the shorter term moving average will cross above the longer term moving average, and your best entry signals will be on the first pullback to the moving average. After the trend reversal, on the first pullback to the moving average, that will be the time for you to take a fresh long position if there is a trend reversal. So in these two attempts, where if you notice, price did go above the moving average, but if you notice, the moving average by themselves are still in a bearish configuration, right? So there is no question of taking long positions in this push up yesterday and a couple of days ago, isn't it? Of course, if you use a different brick size, then your moving average calculation, everything else will be a different. It will be a different looking chart. So I'm using this setting for my positional trading in Nifty. So wherein I will hold on to my positions for anywhere between say 2 to 5 days or something like that. So if you want to use it on an intraday basis, then you can just use a smaller brick size, and you can use the same configuration to get a overall idea about what the trend is. So as long as in 10 point brick size, if prices are making this steady sequence of lower tops and bottoms, you can probably use a smaller brick size, and you can look for shorting opportunity. How or when to enter a shorting opportunity is something that you'll have to figure out where to place a stop loss and stuff like that. So obviously, I cannot design a trading plan for you because I don't know what your risk profile is, what your trading capital is, and stuff like that. So I'm just giving you a broad framework for how to objectively analyze the trend, and how to take objective decision from a trading perspective. So, and let me tell you something, irrespective of what method you use, in a trending market, it's not that very difficult to make money. As long as you have a sensible set of rules, you can anyone can make money in a trending market. What is more important is not to lose the money that you made in a non-trending environment. See, in a scenario such as this, wherein the price is not typically moving away from the moving average, rather it is just crisscrossing or straddling across the moving average, these are the scenarios where you should be cautious and ensure that you don't lose the money that you made in the prior trending phase. So after this phase of consolidation, again, if you notice, a trending phase resumed, and our indicators did a wonderful job. So price went above the moving average, then short-term moving average crossed above the long-term moving average, and then you can decide when to pull the trigger. How to, once you know that we are in a uptrending regime, then you can use your tools and decide when and how to go along, right? And I can show the same thing in point and figure chart as well. Even yesterday in Twitter, I had shared a point and figure chart of the Nifty. Let me just use the 10-point box size here again, right? And let me just quickly clear out a lot of patterns and other stuff so that things are very clear for you. So the gray vertical lines that you see indicates the start of a new trading day. So they are day separating lines. Okay, and let me also mark the buy and sell signals. So you will see a red horizontal line indicating sell signals, and I will also add a blue horizontal line which will tell you where a buy signal was triggered, right? So in the Renko chart, okay, I think I closed it. So you can probably use the Renko chart to get an idea about what the trend is, and then use the point and figure chart to objectively decide where to pull the trigger. So suppose say if you have a simple rule wherein if the price is above the moving average, you will only be interested in long trades, and if the price is below the moving average, you are interested only in short trades. So if that is a simple rule that you have, then a price drop below the moving average here, and then you had a follow through sell signal. So the sell signal was triggered here at 10,880, right? So I'm not making things up here, right? You got a double bottom sell signal here, Your stop loss is going to be one box above the high of this column of X, and your job thereafter is just to trail your stop loss. So if you notice, after this sell signal, the next buy signal was triggered here, which was at 10,760. So you shorted at 10,880 and you covered it at 10,760. This is a 10 column moving average. In point and figure chart, there is no question of time, isn't it? Time is ignored while plotting point and figure chart. So what we do is we take the closing price of last 10 columns and find out the average. So it is this is a 10 column moving average. So this moving average is used just to find out what the trend is. So the simple definition of trend is, if the price is above moving average, we are in an uptrend and we should be looking for long opportunities. And if price is below the moving average, it's in a downtrend and we should be looking for short opportunities. Then you can add a few more filters to ensure that this kind of a phase you don't end up or you avoid taking long trades, because you would have probably taken a long trade here, stopped out, and maybe if you had taken a short trade here, that would have been stopped out. If you had stopped and reversed here, again two back-to-back stop outs would have happened. But that is unavoidable. But if you use sensible filters, you can avoid trades in this kind of a volatile non-trending phase. Similarly here too, if you use a couple of more filters, you can easily avoid these kind of scenarios. And of course, if you had taken this follow through buy signal here above the moving average, your entry would have been at 10,960, and that position would have been stopped out at 11,060. So there was 100 points on the table for you to take it. And again, these are all objective rules that I'm telling you, and I'm not trying to curve it or second guess anything. So in trading, the most important thing is to have a very objective set of rules, and then do adequate back testing, and then blindly stick to the rules. These are the only three things that's required. You don't need any other indicator, isn't it? You just need to know whether we are in an uptrend or a downtrend, and whether we are in a trending mode or not. Once you have this intelligence, the basic intelligence that we are in an uptrend or a downtrend, and if that trend has some momentum behind it, then you use any logical method to initiate a long or short trade. That's it. And have a stop loss, and have a sensible way to trail your stop loss. This is what is required. So you can use any chart, any method, any tool, as long as these things are taken care of. The logic remains the same. Just that we like a point and figure or a Renko chart, because it makes life relatively easier, and the entry exit points are very clearly defined, which is why I personally like a point and figure chart. How to avoid losses? Losses cannot be avoided in trading. However brilliant a system you have, you cannot have 100% winning trades. I have never come across any such system in the world. So that is not going to happen. So the best of traders probably have a system wherein the winning trades will be like 50 to 60%, and there will be 30 to 40% losing trades. So don't ever get into this habit of thinking about how to avoid losses. That's not going to happen at all. Okay, another question we have is how to sell at the top and buy at the bottom. Yeah. Again, you have to be God or you have to be a liar to do that. It's not consistently doable here, nothing at all. To be profitable in trading, you just don't have to second guess where the market is going to turn. You just don't have to do that. So see, we can take any I can take any stock and tell you that these things are not required at all. See, the moment you get into this habit of trying to predict what price is doing, or second guess where a top or bottom will be, that's when you're going to be really screwed. See, this is Page Industries, and I'm using a 1% box size. So as per our definition, the trend reversal happened here, isn't it? price went above the moving average, and then the green moving average crossed above the red. So we need not second guess whether this is the bottom or this is the bottom or this is the bottom, isn't it? Because we know that whenever a bottom has happened and the price gets into an uptrend, these things has to happen, isn't it? This is pure statistics. You don't have to really what shall I say, look at some fancy stuff like Elliott wave or GAN or whatever. Those things work for a lot of people, but what I'm saying is you don't have to really get worked up about those things, because these simple tools, this configuration has to happen, isn't it? There are no two ways about it. If from a downtrend, if the price is turning around and getting into an uptrend, definitely price will be the first one to cross over above the moving averages, and if the trend continues, the short term moving average will go above the long term moving average. These three things has to happen. Then what you can do is you will have to decide how and where am I going to take long positions. So even if you had entered at the highest point here, which was at 25,000, look at where price went thereafter. It went up to 36,000. So you still made some 50% returns, isn't it? Without second guessing, right? Okay. So I'm not an expert on options or straddles, so I'm not taking that question. Sorry, Anshul. Expiry range for Nifty, Bank Nifty. Again, as I told you, I'm not good at options, so I don't think I can give you any meaningful idea about where the expiry is going to be. Because AP does a good job. My colleague AP does a good job of using the straddle chart to find out a reasonable range for expiry. But I'm not in that game at all. So I'm basically a trend follower. So I just stick to my set of rules. For Renko chart, what time frame should be used? You can see if you're a short-term trader, meaning if your holding period is anywhere between say 1 day to maybe 5 days or so, then you can use a 1 minute closing price, and for Nifty you can use a 10 point box size. Or if you're looking at stocks, I'm not too sure. Let me see what is the default setting. You can stick to that. Give me a second, guys. So for stocks, I think 1% will be slight. I'm not too sure. Brick size of maybe 0.5% should be a better thing to look at in a for 1 to 5 days of trading in stock futures. You can probably play around with the box size. Start off with say 0.15 or 0.25, and go up to zero point 0.5, and look at how noisy the chart is, and then you come to a conclusion about what will be the right box size. See, for if you're using a point and figure chart, the default setting will be 0.15% on a 1 minute time frame for stock futures, and for Nifty and Bank Nifty, you can use absolute box values of 10 and 5 for intraday. Okay, so Asim is saying that the problem with Renko is that it is based on closing prices, and it's dangerous to keep stop loss on Renko. We would have gotten out, but okay, fine. So, given allowance of maybe 4 or 5 points, Azim. See, every method that you use, there is always advantage and a disadvantage associated with it, right? So, and not too frequently will you see instances wherein your stop loss or entry is triggered, but on a closing basis, that entry or the stop loss turned out to be a false alarm. It's in very rare occasions it happens, especially when you use 1 minute closing prices. That kind of a scenario will be relatively rare. I'm not saying it is not going to happen at all, but those are relatively rare. And as I told you, you can probably give an allowance of 2 3 points or so, instead of putting the stop loss exactly at the lower box level. You can probably just give a little bit of wiggle room. See, in volatile markets, it stop loss gets taken out either which way, isn't it? Irrespective of what method you use, if the market is volatile, then you just can't do anything about it. Yeah, so stop loss on both directions are going to be hit. So maybe what you can do is, you can probably just uh, implement, what shall I say, volatility based stop loss. That is even more sensible, but that would mean that your stop loss is going to be a little bit more wider than what it is in normal scheme of things. So if you uh, if you take into account of what the volatility is, then you'll have to position size accordingly, because your risk is going to be slightly wider in that case. So if you can do that, then this shakeout that you're talking about can be avoided to a big extent. Entry and exit both on closing basis, yeah, preferably on a closing basis, but of course, as far as exits are concerned, you have a resting order in the system. Don't wait for the closing prices to happen, whether you are trading intraday or EOD basis. Always, as far as stop loss is concerned, it should be in the system, right? Okay, let me quickly see if there are any questions that I haven't answered. Okay, someone is asking about IT index view and a view on Apollo tires. I'll quickly take those two questions, and we'll wrap up the discussion there, guys. Let us take a look at what the IT index is doing. Nifty IT index, the trend is bullish, but we are in a corrective phase now, right? And I don't know whether this will end up as being a double top. Last, when I had this session with you guys, maybe a few weeks ago, IT index was one of the outperformers, and I was very bullish on the IT index. I still remain bullish on IT index. This column of O doesn't bother me much, right? So let us see. We'll just have to give it a little bit more time to see whether price is struggling at prior highs. Whether if I get a sell signal and if the price falls below the moving average, then I'll get more bearish or less bullish on the IT index. But at the moment, the index does look okay to me, and nothing to really be worried about. And if you look at the relative performance of the IT index, it is still doing better than. See, again, you can use this one. What is it? A Renko chart. uh, Give me a second. Give me a second, guys. I'm not talking about line break. I'm talking about. Yeah, you can use the Renko chart if you're comfortable with it. You can use that for calculating or looking at the relative strength chart as well. So let me just use a 0.5%. So this is your simple ratio chart or relative strength chart of IT index divided by Nifty 50. So if we are in an uptrend, it basically means that Nifty IT index is performing better than the Nifty, and if we are in a downtrend, it basically means that Nifty IT index is not doing better than the Nifty. So if you notice, you had this steady sequence of lower tops and bottoms, and then price bottomed out. Again, if you notice, you can use the same set of rules that I told you. Look at where the price is in relation to the moving average, and look at where the moving averages are in relation to each other. So clearly price is above the moving average, and the short term moving average is above the long term moving average. So the overall configuration is bullish. From a slightly micro perspective, if you notice, we have a series of red bricks, which basically indicates that in the last few weeks, IT index is underperforming Nifty 50, which is bound to happen, isn't it? Just like your price chart, your relative strength chart, it also oscillates in swings. So we had this big one-sided run-up, and price got extended to the upside. So it is just cooling off and getting back to the moving average. So my ideal setup will be if there is a buy signal in point and figure chart anytime soon in the relative strength chart, then that is a very clear-cut indication that this ratio chart is resuming its uptrend. So I will then consider adding IT stocks to my portfolio. What is the optimal moving average to use in Renko charts? See, the default setting is 20 and for 40. That is what I'm using here. Again, you can use any length. See, irrespective of whether you are using a Renko chart or a candlestick chart or a bar chart or whatever, it doesn't really matter. You use two different moving average lengths. Any two length is okay. See, in an uptrend, if you use a shorter length moving average, your signals will be earlier, but again there will be a lot of whipsaws. If you use a slightly lengthier moving average, then the signals will be slightly delayed, but they will be more reliable. So it depends on what kind of a trader you are, what time frame you are trading. Based on that, you can choose the uh, moving average length. See, but you can definitely use say 25 days and 50 days. It doesn't really matter. Or you can choose two numbers which numerologically sounds lucky to you. As long as you understand the logic and use it consistently, that is good enough. The length of the moving average, there is nothing magical about that. Okay. Okay, thanks guys, thanks for showing up. We'll just wrap it up here, and we'll meet at 11 o'clock next Wednesday.